We're jumping straight into intuitive machines today. Everyone is watching the price action, but the real story is the massive structural shift happening underneath the hood.
Right.
I mean, look, the stock has surged, what, 47% in the last month alone?
And it just jumped again recently, another 12.5%.
Exactly, hitting highs near $22.42.
Right.
But if you're just staring at that green candle, you're missing the forest for the trees.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we break down why this isn't just a moon stock anymore, do us a favor. Subscribe and hit the like button so you don't miss these daily breakdowns.
All right, let's get into it. You said the price is flying, but the chart isn't the main event. So what is?
The main event is what happened back on January 13th.
Okay.
The completion of the acquisition of LUNR Space Systems. This is an $800 million deal. And I need to be really clear here. This isn't just Intuitive Machines buying a competitor or, picking up some spare parts. This deal fundamentally changes the company's DNA.
That's a big claim, changing the DNA.
It stops them from being just a lunar delivery service.
Yeah.
And it starts their transition into what Wall Street is calling a space prime.
A space prime. Okay, we hear that term thrown around a lot in the defense sector. It sounds impressive, but, whenever companies start using buzzwords, I get a little skeptical.
I get it.
What does that actually look like for the business model?
It's all about scale and control.
Yeah.
Think about it this way. Before this deal, Intuitive Machines was like a very, very specialized trucking company.
Okay.
They had a Nova Sea lander. They take your payload, put it on their truck, and, drive it to the moon.
Which is a cool business, for sure, but it's inconsistent. You drive the truck, you get paid, then you wait for the next job.
Exactly. It's episodic revenue. It's lumpy. But by buying Lanteris, they aren't just the trucking company anymore. Now they own the factory that builds the trucks, the engines, the whole 9 yards.
Okay, that's the metaphor. Now give me the hard numbers. How does this actually change the spreadsheet?
The jump is, it's staggering. Before Lanteris, Intuitive Machines was looking at revenue around, say, $220 million.
Right. Respectable for a growth company?
Sure. But now, the combined entity is projecting over $850 million annually.
Whoa.
Yeah.
You're effectively quadrupling the revenue baseline overnight.
It is. And the market's reacting to that scale. We saw that volume spike of 27 million shares traded recently.
Mm-hmm.
That tells me the big institutional money, the funds that couldn't touch a small cap speculative stock before, they're waking up. They see a path to $1 billion in revenue.
But revenue's one thing, growth is another. Is this just a one-time bump because they bought a bigger company, or is there real organic growth here?
Well, analysts are forecasting 70% annual revenue growth.
70.
70% over the next 3 years.
Wow. 70% CAGR. That is incredibly aggressive. How do they even justify that?
So this brings us to the moat. And this is where we have to get a little technical about what Lanteris actually makes.
Let's do it.
They didn't just buy a brand. Lanteris specializes in flight-proven satellite buses, advanced power systems, and this is the key nuclear thermal propulsion tech.
Okay, hold on. Satellite bus. Simplify that for me.
The bus is the chassis, the body of the car. Every satellite needs a structure, power, thermal control.
Got it.
Before this deal, Intuitive Machines was building their landers, but they were relying on third-party suppliers for a massive amount of the critical components.
Which is a complete nightmare in the space industry. Supply chains are so slow.
Right.
If your vendor is late with one valve, the whole launch gets scrubbed.
Precisely. And in this business, a scrub costs millions. Now, with Lanteris, they bring all of that in-house. They have the power systems. They have the propulsion.
They're vertically integrated.
That's the term.
So they control their own destiny. They aren't waiting on a supplier. They just, walk over to the other building and get the part.
Right. And that protects them from competitors like Rocket Lab or Blue Origin who are trying to do the exact same thing. Owning the stack is the only way to protect your margins.
And I've got to assume this vertical integration makes them way more attractive to the biggest customer in the room.
The U.S. government.
Yeah.
It makes a huge difference. The government doesn't want to hire a startup that might go bust because a supplier failed. They want a prime. Right. They want reliability.
And we see that trust in the numbers.
It's showing up in the backlog. The backlog is expanded to $920 million.
Nearly $1 billion in signed work.
And it's the type of work that matters. A lot of this new backlog is NASA's Near Space Network contracts.
Hmm.
This isn't just let's land a camera on the moon. This is let's build the communication infrastructure for cislunar space.
So steady, recurring revenue.
That's the goal.
Okay, so the bull case is pretty clear. Massive revenue jump, vertical integration, billion-dollar backlog. But you have to play the skeptic here. You're describing this like it's a done deal. But space companies are famous for one thing, right? Burning money. Is this company actually profitable?
Well, that's maybe the most boring, but also the most important part of the bull case.
Go on.
The legacy business, the original intuitive machines, was absolutely burning cash. R&D for lunar landers is incredibly expensive.
You're basically just setting piles of money on fire until the rocket works.
Pretty much. But Lanteris is different. They're an established manufacturer. They've been building satellite components for years. They are cash flow positive. They bring positive EBITDA to the table immediately.
So they bought a cash cow to feed their moonshot.
That is the strategy in a nutshell. Analysts are projecting a turnaround to net profit by 2026, specifically because of this deal. It stabilizes the whole ship.
It buys them the runway they need.
Exactly.
Okay, that sounds fantastic. $850 million in revenue, positive EBITDA on the way, everything's great. But
Here it comes.
I'm looking at the balance sheet right now, today,
Yeah.
and it does not look like a stable ship. It looks more like a ship taking on water.
You are not wrong. If you strip away all the future projections and just look at the trailing 12-month numbers, it is ugly.
How ugly are we talking?
We are talking net losses of negative $193 million.
Ouch.
And the efficiency is terrifying. Net margins are at negative 87%.
Negative 87%. So for every dollar of revenue they bring in, they're spending almost $2. That's unsustainable.
It is the definition of cash burn. They are burning the furniture to keep the house warm right now. And to make this acquisition happen, they didn't just use cash. They had to leverage up.
What's the debt situation?
The debt-to-equity ratio is high. It's sitting at 137.3%. That is a heavy backpack to wear when you're trying to climb a mountain.
And the deal itself, $800 million. They obviously didn't have that in cash.
No. They used about $350 million in stock to get the deal done.
Which means dilution.
Massive dilution. If you were a shareholder before January 13th, your slice of the pie just got a lot smaller.
Management is betting that a smaller piece of a space prime is better than a big piece of a struggling lunar startup.
That's the bet.
But there is another risk here that worries me more than the debt. You can fix debt if you have revenue, but you only get the revenue if the technology actually works.
The execution risk.
We have to talk about the tip. I mean, the whole space prime narrative is built on the idea that they're the leaders in lunar landing, but their track record isn't exactly spotless, is it?
You're talking about IM-1, the Odysseus mission.
Yes. The headlines all said, "Success, first commercial lander on the moon."
But if you read the fine print,
Yeah.
it was a little more complicated.
It was a white-knuckle ride. Let's actually recount what happened because it illustrates the risk perfectly.
We do.
Hours before landing, the ground team realized the laser rangefinders, the eyes that tell the lander how high it is, they weren't working.
Why not?
Because someone on the ground forgot to flip a physical safety switch before launch. A simple physical switch.
That is a nightmare scenario. So they are in orbit around the moon, realizing they're flying blind. They had to scramble and patch the software in mid-flight to repurpose a different NASA sensor that was just supposed to be a tech demo.
They literally hacked their own lander while it was circling the moon.
Which is, it's heroic engineering, don't get me wrong.
It's incredible. But what was the result?
The result was they came in a little hot, a little sideways. They caught a landing leg on a rock or something, and the lander tipped over.
It landed sideways.
It functioned. They got data. So, technically a success. But if you're a customer paying $100 million to put a sensitive telescope on the moon,
You need that telescope pointing at the stars, not into the lunar dirt.
that's the issue. You can't be a space prime if you land sideways. Reliability is the entire product.
And if the next mission has a similar glitch, the brand takes a massive hit.
And that's just the physics. We also have to talk about the corporate physics. Merging two companies is never easy.
The culture clash.
Think about it. You have intuitive machines. They're a startup. They're cowboys, right? Hacking software in lunar orbit, moving fast and breaking things.
Okay.
Now you're merging them with Lanteris. Lanteris is a legacy manufacturer. They build components for classified satellites. They are process-driven. Risk-averse.
That sounds like oil and water.
It's a huge risk.
Yeah.
If the engineers from Landers get frustrated with the cowboys from Intuitive or vice versa, you get brain drain, you get delays. And if you get delays, that projected 70% growth rate just evaporates.
And I saw one more red flag on the tape. Insider selling.
The CEO, Steve Altimus.
Yeah. He sold a pretty decent chunk of stock recently.
He did, about $40 million worth. Now, to be fair, this was done under a pre-scheduled trading plan, a 10b5-1.
So it was planned in advance. I get that. But $40 million is a lot of diversification.
It is, and optics matter. When the captain unloads $40 million in stock right as the share price is rallying on this space prime news, it kind of signals that maybe he thinks the valuation is getting a little frothy.
It's a caution signal for sure. Okay, so we have a clear picture. On one hand, space prime shift, quadrupled revenue, huge backlog.
Right.
On the other, high debt, massive dilution, and a history of, let's call them technical successes that involved landing sideways.
It's a battleground stock. No doubt about it.
So for the listener trying to figure this out, what are the triggers? What happens in the next 30 days that could settle this debate?
The calendar is packed, but there is one date that matters more than anything else.
Catalyst number one?
The launch. The IM-2 mission. It's named Athena. The launch window opens February 26th, 2026 from Kennedy Space Center.
So why is this one so critical? Is it just about proving they can land upright this time?
It's about the payload. This mission is carrying the Prime 1 experiment for NASA. That's an ice mining drill. They're going to the lunar South Pole, which is much harder to land on, to drill for water ice.
Ah, this is the resource extraction test?
Exactly. This isn't just can we get there. It's can we get there, land precisely, and operate heavy machinery in one of the harshest environments in the solar system.
So if they stick the landing and the drill actually works?
It proves the tech stack is mature. The stock probably flies. But if they tip over again, or if the drill fails, gravity takes hold. The space prime narrative collapses right back into risky startup.
Okay, February 26th. Circle it. What else?
Catalyst 2 is earnings. We're expecting the Q4 2025 report in late February or early March.
And this will be our first look at the combined books, right?
First, real guidance. Investors need to listen very closely. Management has promised all these synergies from the Lanteris deal. Are they really happening? Are there hidden integration costs? This is where the rubber meets the road on the financials.
And catalyst number 3, the contracts.
The big ones. We are waiting on a decision for the Lunar Terrain Vehicle contract, the LTV.
The moon buggy.
It sounds fun, but it's a multi-billion-dollar program over its life cycle. Winning that would be massive. And there's also chatter about the Golden Dome missile defense program.
Golden Dome? That sounds serious.
It's very serious money. If they land a national security contract like that, it validates the space prime status instantly.
Right.
It moves them from being a NASA science partner to a Department of Defense asset.
And DoD assets trade at much higher multiples.
Exactly.
So let's bring it all home. What's the final verdict here?
Look, this is a classic high-risk, high-reward play. You're betting on the U.S. government's commitment to building out permanent infrastructure in space. You are betting that the space prime thesis is real.
But the market is already pricing it like the victory's been won. It's trading at a premium sales multiple.
It is. The market has priced in the success of the Lanteris integration. The next 4 weeks, and specifically that February 26th launch, will determine if that premium is justified, or if the stock comes crashing back down to earth.
It really all comes down to the launch.
Check your risk tolerance. This isn't a savings bond. It's a volatile, aggressive growth play.
Definitely not for the faint of heart. But before we sign off, here's a final thought to chew on. We talked a lot about the moon today, landing on dirt, drilling for ice. But with the Lanteris acquisition, I think the real story might be invisible.
Invisible.
Data. With the Near Space Network contracts and all of Lanteris's high-tech comms gear, Intuitive Machines is positioning itself to be the ISP of the solar system.
The internet service provider for the moon.
Exactly. As the space economy grows, as more landers go up, as bases get built, the most valuable commodity might not be helium-3 in the ground. It might be the bandwidth to send the data back to Earth.
That is a fascinating angle, the Cisco of space.
Building the pipes for the data, that is a recurring revenue model that never goes away no matter who's doing the mining.
Well, we will be watching the launch on the 26th very closely to see if they can keep that connection open.
Thanks for listening to the Easy Money Show. Keep it simple.